Property Finance Uncut, the must-listen podcast for anyone with a mortgage. Find out the truth about what Australia's lenders are up to and how to make sure you're in the best possible position when it comes to your property finance.
And it is the must-listen podcast to anyone who cares about their mortgage, which is a third of all Australians. I know that for a fact. A third of Australians have a mortgage. A third of Australians rent. The other third, they own their own home and they don't have a mortgage. They're the rich buggers who
inflation
aren't really
creators.
getting hit too hard. This is it. They're the baby boomers. They're not us struggling our wage. Struggling. I'm a Gen Xer. What are you, Paul Glossop?
I'm Gen Y. Still Gen Y.
So Paul Glossop, you're just a Gen Y, aren't you?
No, I know. It just doesn't make a difference.
The top end of Gen Y. Paul Glossop, CEO of Finni Mortgages, finni.com.au. We get together every single month. We talk about interest rates, but we also have a fair bit of argy-bargy during the course of the month as we try and work out what's going on. I actually called Paul after the inflation data come out the other week saying, mate, what are you doing? What are you talking about? There's still inflation, mate. It's 5.6%. And he goes, no, Phil. No. Look at it on a monthly basis. It's pretty much at zero. Or it's negative. You take into consideration wage growth. So it sounds like some of these impacts and the hard world that a lot of Australian mortgage holders sit within, they're tightening up the belts and things are getting a bit cheaper. And the Reserve Bank of Australia just literally a couple of minutes ago decided to keep rates on hold, 4.1%.
And the really interesting thing I think we're at here now too, mate, is that here we are. What are we? We're two more RBA meetings away from Dr. Governor Lowe, Governor Lowe rather, but from essentially stepping down from his mantle. So you've got to ask the question now, like, realistically, is that mandate now sort of the baton already being passed with this decision? Because we've got two more before we go back to what is going to be every 3 months meeting and a whole bunch of different ways that this is going to be looked at. So it's interesting times, and the data is suggesting that for sure.
So let's quickly talk about that. So this is a structural change which come out of a recommendation of splitting the board and having a monetary policy setting, and also so all that stuff is happening. So they're only going to make rate announcement changes on a quarterly basis. Did I get that right?
I believe it's quarterly. I think there's a time over the December and January period where I think it's going to be 2 months. So there's a 2-month hiatus there. So I think it might be every 2 or 3 months. I think there might be 3 or 4 meetings a year as opposed to 11. I think it's going to. I think there might be some differences between that.
Yeah, I recorded the podcast on this probably 2 months ago, just after they made the announcement. I had a good chat about it with Annie Kane, who heads up the advisory with Big Mortgages brand here at Momentum Media. And I know there were recommendations. I must admit, I should be more connected than I am, whether or not they were handed down. But irrespective, rates have stayed stable this month, which I imagine for a lot of people out there, they've gone,
you. Yeah. And
with a grim reaper sitting on their door, sort of,
completely.
But so things are starting to change also. And we'll have a chat about it now in that banks' serviceability. And I know we're here to talk about home loans are changing. They're reducing buffers. But give me your catch-all on the rationale for the Reserve Bank this time around for keeping rates on hold.
Yeah, well, I guess my mail was the fact that the May data that was released was essentially showing that we're at the slowest annualized monthly inflation in over 12 months. And if you look at it from essentially from January to May this year, we're well and truly inside the band. So we've grown about around about 1.2% as total inflation from January, February, March, April, May this year, and within that band of 2 to 3%. We're falling within that right now, annualized, and it's slowing. So we're not exactly accelerating towards the back end here. Now, there was obviously a couple of random speed bumps. April was a strange read of that monthly data, and I think a lot of that was a fuel excise cut, or the levy that was implemented. That was cut for that particular month, which showed a bit of a spike in actual fuel prices. But I think that might have been a bit more of a seasonal blip on the radar, which isn't going to be consistent. But I think that's where the RBA are probably now focusing, realising that much of the heavy lifting that was done in the back end of last year, and obviously all the rate cuts that have come at the start of this year, there's a big time lag effect. And as we know, most people are going to be affected by their mortgage repayments. And there was, the best part of 35% of people fixed their rates over the last 3 years. Now that is really starting to come off this year. Now, that doesn't happen at once. And I think the people who feel the effect of it happens incrementally. So we're essentially going through the bulk of where those interest rate mortgage fixed to variables are starting to happen. And in turn, that's obviously starting to mean that people are spending less because they're realizing that they don't have the same disposable income. And the desired effect is being had. So hopefully this is good news and signs to come of a bit more of a tempered approach to interest rates moving forward.
Yeah, see, I'm not convinced that this is the end of it. We're still below where they are in the States and over in the UK, and often we always just go just beyond what happens in America. So, intrinsically, there's got to be more in it. But when you talk about the observation you just had, which is based on narratives of the Reserve Bank, and I just quickly looked up what the notes were that come out of this meeting, and the Reserve Bank governor saying monetary tightening still may need to take place. So they're leaving their powder dry to go again. And it just feels as though there's two more, like there's two more in it. I just get the sentiment for it now. Whether or not this is a reprieve for Australians for a period of time, structurally, are they going to be able to increase rates at the same speed if they're not meeting so often? I've got to go and check in on that and make sure I'm right on how that's going to work before I can give an informed discussion around it. But most Australians will be sitting there going, "Well, I've got another month if I'm keeping the wolf at the door." That said, there's two things happening here. There's the variable rate increase, official cash rate, which impacts the variable rate if you have a variable rate mortgage, and there's things you can do about that, Paul. We'll have a chat about that. But it's for other people who are going to have that, seismic shift, that seismic shock of fixed rates coming off and onto variable rates. And they haven't been on this journey since May of 2022 of this incremental sort of rising of interest rates of variable rate people. That's going to be a big shock for a lot of people. And I know personally some people who are working through that right now with their accountants, and they're sitting there going, I just can't make it. I just can't make the ends meet. What am I going to do?
And that's the proverbial fixed rate cliff that's been talked about for some time. Obviously, the data showed that this was going to be the year where the bulk of these fixed rates was going to come off. So this is going to be the year where the bulk of the hurt's going to happen. So I think that's the big stuff that takes time to play out. And the reality is that we've already at our highest interest rate levels in over a decade now, and any more interest increases to that is only going to put more and more impact on that. I guess some interesting information, and I was listening recently as of earlier today. Aussie Home Loans actually did a survey of their customer base, and obviously they've got one of the largest customer bases of any mortgage brokers and mortgage holders in Australia. So they've got a very big and diverse customer base, and they surveyed over 1,000 of their customers. A really interesting fact, basically asking about what's happening with their rates. One very big key question they asked was that, have you asked your broker if there is a better bank or rate than what you currently have in the last 12 months? Over 70% of those 1,000 plus people surveyed said no. And that's really interesting.
I just can't believe that, right? But
it's
maybe because we live in a bubble that we live within, where we think everyone's sort of uber focused on their mortgages. You go, really? Like 7 in 10 people who
haven't asked the question,
who are impacted by rising rates, haven't done something about it.
Well, they haven't even inquired. I guess that's the question. They haven't actually even asked their broker. They haven't asked the question saying, am I on the best structure? And out of those 7 out of 10, the reality is that almost 50% of those surveyed, when they were asked the question, is that if there was a better rate, would you shift? Almost half of those 7 out of 10 said yes. So I think this is...
What are the other half doing?
Well, I think laziness, unfortunately, and complacency.
But you're saying if you ask the question of whether or not there's a better rate, would you move on to it? Only half of people are saying they would.
Only half, correct.
No.
But that's exactly what their data said. That's because
so half of people. So the other half of the people
said, "No, I couldn't be bothered.
Give you a better rate if you move banks." Go, no, I'll say the bank I am.
And I think this is where the big question is that what are they going to gain? So for me, it always comes down to you can. Well, it depends, right? Because you could revert from the same bank from fixed rate to a variable, and you might go onto a decent variable rate because you can hassle your broker or your bank directly and say, give me the best variable rate you've got. that variable rate may be great, but it also, the reality is about half of the time, we've found that about half the time, there is going to be a better option with a sharper rate and, if not the same structure, better structures. But when it comes down to it, if it's a 0.1% versus a 0.5%, that's where the difference of people say, well, what does that mean for me from a dollar in, dollar out basis? If it's going to be negligible, some people are just like, look, I understand it might be, it's just, that's too hard basket for me to save a few $100 a month. Other people saying a few $100 a month makes all the difference. So absolutely, I'm going to do it. And if you've got a good broker, they should be doing that work for you anyway. But it's just interesting.
Yeah, it is. Well, the psychology of people, right? But the interesting thing for me, and what, if you're tuning into this and you have a fixed rate product that's coming off on a variable, just don't, whatever the bank tells you your variable rate is after coming off a fixed rate, just don't go, okay, that's fine. Like, that's when you want to negotiate. Absolutely. Like, just don't, just because they go, oh, your new rate is this, go, okay, yeah, sure, no worries. I'll move on. I'll tighten the belt. I'll get rid of a Netflix subscription and stuff. Like, that's where you need to negotiate. And that's when you need someone helping you out with it if you haven't got the capacity to do it yourself, aka a mortgage broker, right? Which I'm sure you're going to tell us you guys can help us with at Finni.
Well, we absolutely can, mate. But
I'm sure you can.
But I guess before I go into that, and I'll probably ask you a question, because you're, not to say that you have one loan, you have an investment portfolio with multiple loans, but those loans have been accruing over the years and the structures are different. But obviously you probably haven't felt the impact of those loans until the last 12 months where it's actually making a significant change to cash flow.
Mate, I know it is, right? Because now I've got to throw some bucks in to meet repayments.
Yeah, absolutely.
And like I noticed that, and I sit there and just go, oh, I don't like this. Just the other day, because I actually one defaulted because I've just been conditioned that the money that goes in is enough to pay the money that goes out, right? So I've just been conditioned. Our thing pops up and go, what is that really that
You're
much?
In arrears.
Like, that's crazy. Like, I've missed the repayment, which happens to us all, right? It's the way it is. But I'm noticing it, and I'm going, well, I'm okay with it. I'll find the money to plug the gap. But but as you know, like, your team now is refinancing a lot of my loans from P&I to interest only, just for a cash flow point of view. And what I have noticed, and you should go and check this out, I haven't been into this. I won't say the lender, but I've got 6 loans with this lender, Paul. And I hadn't logged into the bank for, I don't know, probably 6 months, right?
Right.
So I logged into it and I went, what's all this positive balance on stuff, right? So P&I mortgages, and I said there was like $7,000 there, $4,000 there, $3,000 there, $2,000. They went, what's going on now? So I sit there and go, man, well, something's not right here. My repayments were higher than the minimum repayments.
Right? So you tick the box.
So it's just been going in. It's just been offsetting as a redraw type thing. It's just been offsetting the interest repayments. I went, I don't want that.
No.
So I moved all the money out so I could as a cash flow point of view. But if you've got to be dialed in with this stuff, and if you don't know, you got to speak to your broker about it. I just went, really? That's crazy.
Yeah, absolutely. And I think the reason why I raise that, Phil, is that your situation is not necessarily classic, how you're going from fixed to variable and you're rolling off onto potentially a fixed rate cliff. Your position is saying, well, you're on P&I, your structure was P&I, which was set some time ago on a range of investments, because you're like, okay, well, let's go through a pay down phase. But then that's holding consistent on a much lower interest rate. The reality is that's gone up. So you've looked at it and say, well, it's pragmatic for me to say that was a point in time. This point in time, cash flow is not as good, so I'm going to switch. So it's not just people who are thinking, hey, rates are going up, I need to switch to variable and find the best rate. But it's also, what is the structure that I'm on? Is that the best structure? Because there is a variety of structures which will suit you. And remembering that they're not permanent. You choose to go P&I, you choose to go interest only. These aren't till death. These essentially are choices for a period of time. And that's where your broker will strategize. And that's where our job is to strategize with you, with your portfolio, is to figure out, well, how long do we want this to be interest only for? What's the thoughts? Do we fix it on interest only? Do we keep it variable? Do we make sure there's an offset account? All those different aspects, and different loans have different needs and purposes. So I think that's the big thing to highlight here, is that strategy conversation, as much as it doesn't mean you have to do more homework, it just means that we have that open conversation to figure out what's the intention of all these debts. And it's not just, hey, I'm going from fixed rate to variable, can you get me the cheapest rate? Because that's not the conversation that we've been having.
No, it's not. And the challenging thing for a lot of Australian borrowers, whether they're investors or owner occupiers, and it's relevant for owner occupiers and investors, is if you play the fixed rate game, you're betting against the banks, right? And for a lot of people, they've won. over the last couple of years. Well, the last year at least, right? So they've locked in really low fixed rates. I've got some stuff that's fixed. I've beaten the banks, right?
Yep.
By some margin. I'm sort of say fixed at 2.5 and they should be up at sort of 6.3 now, probably 6.4%. So like happy days, I've beaten the bank. Don't think you're always going to beat the banks when it comes to fixing rates, particularly in this environment. And I was chatting with my accountant. I think we share the same accountant.
Correct.
I'm happy to say his name, Manzrul Khan. I get him on every now and then. I was chatting with him yesterday about it, and he goes, Phil, he reckons there's a couple more. I'm not sort of paraphrasing. He reckons there might be a few more, but his view was that on this notion of fixed versus variable, he goes, the Reserve Bank of Australia is well known to start late and finish late. So the idea being that they started lifting rates back in May of last year, April of last year. Sorry, May of last year, when they probably should have started probably 3, maybe 4 months earlier, right? So they started late, and he reckons they'll end late. And he spoke about this, to your point. I think April was this when everyone went, "What's going on here? They put it up again. There's no way in the world they could be putting up again." But there's got to be this idea that when it's time for them to stop, they'll keep going a little bit further. So I think we're now in this phase of they'll keep going a little bit further. So is that it? Or is there still 2 more in there? Is there 3 more? Is there 1 more? I don't know. But I think when you look back at this period of time, in a year or 2 years' time, they're going to say anywhere between March and probably August of this year is going to be the zone when the RBA probably should have stopped lifting rates.
It's a high watermark.
And sort of that's so we're in that moment right now. But only in hindsight you're going to know that you're here. So if you're coming off fixed rates right now, and this is not financial advice, and you run a mortgage broking business, I don't, but you've got to get your timing right. If you're coming off fixed, be very, very careful and speak to your broker about whether you go straight back onto a fixed rate. Because if you're in the business of betting against the banks will always win in time. It's well known that variable rates, if you're holding more debt over a long period of time, ends up being a better thing. So, but this is going to be one of the big things you need to deal with, right?
Completely, mate. And I think this is probably the thing I wanted to maybe finish up our podcast with today is probably more just some positive news for anyone who's listening to this, because we've gone through a lot, and everyone who's listening to this will either themselves be directly impacted or also know someone, and maybe quite a number of people who are genuinely being impacted by the cost of living, most being the price of their mortgage or their rent or however they're going to be paying for their living. What's happening right now, and probably what will be happening for the next 6 months, 12 months, maybe 18 months, will be as bad as it gets for a relatively long period of time. So we're kind of, if we perceive it to say, hey, we are in the thick of it right now. And if you're looking at your numbers and you're sort of holding steady, and you can figure out a way to get there, whether that's going to be a second job, whether that's dialing back on the Netflix subscriptions, whether it's shopping non-brand name groceries, or a combination of all these things, which, Phil, you and I have done, and we've lived in families that have done that back in the 80s, and we remember it, and we know that these times happen. They don't typically happen forever. This too shall pass is sort of the main passing comment that I make to that. But I guess what typically happens after this is there's a lot more ammunition now to actually cut rates and stimulate when needed. So I think for me, that's a very big positive, because we went through this 2 or 3 year time frame where there was no bullets in the chamber, for lack of a better term. There was no ammunition. If things went south from where we were in a bad place. And we realize now that we're in a much more tidy place, that if we want to stimulate again, that stimulation is able and ready. So I think people need to take solace that this is a short-term issue for what will be a longer-term, better outcome that we should all be able to achieve.
Which for a lot of people is going to be hard to accept when you're sitting there going, yeah, that all sounds really good, Paul, but this, that. There's a lot of people doing it tough.
Completely.
So that's nice to think that the future looks good, and I subscribe to what you're saying, and I would add to that. I think there will be a sustained period of price growth in property over the period ahead. It's just when that starts, right? The biggest main issue we have right now is liquidity, people's ability to access finance, and things is happening there. So there is innovation, right, around it. There is they're conscious, and banks are very conscious now, and you see a happening of this notion of being in mortgage prison or mortgage jail, which is I could afford to pay my loan. It's hurting like hell, but I can afford to pay it. I reckon I could get a better product at a better rate somewhere else. However, I don't suit or meet the serviceability requirements because rates are high and we've still got this buffer in there. They're starting to be a bit more pragmatic around that, correct?
That's the big one, yeah. So banks are ready. Banks know that this conversation is happening far more often, and obviously they're training their teams. They're looking at their servicing policies, and they're figuring out solutions with innovative options to actually be able to take on not only reservice their existing clients who are going from fixed to variable, but also to win new business, because banks aren't shut up shop. They are certainly still open for business, and they're wanting to find any new business they can possibly find. So I think that's the big message here, is that don't think that if you're sitting there and one broker or one bank says you got no chance, there is going to be solutions for a lot of people that may be unknown for the short term. So don't rest with one opinion if it's not the right outcome that you think is achievable. Make more phone calls, get in touch with us. We're here to make sure we field those phone calls and look at solutions. I think last I checked, we've got around about 70 lenders on our panel that we can have a discussion with. That's a lot of policies that we can look at and a lot of different scenarios that might fit your criteria. So yeah, I guess that is the big one, at least for the next 6 to 12 months, whilst these times are probably going to be as tough as they will be. Ask the question. If you don't like the answer, ask it to someone else and ask it a million times over until you keep getting the same repeat answer, because there's going to be solutions somewhere. So
I know you guys are busy, and I don't want to get people to call you up because I want my loan sorted out first, please. But you guys have capacity. You can help.
We definitely do, mate. We actually just poached a broker from a very well-known bank as of last week. So we intentionally want to make sure we're getting the best of the best. She's also a property investor, and that's one big thing that we are very staunch on, is that the people we bring in as far as our brokers are, first and foremost, they own, they invest property, and they've also got a lot of experience with a lot of different lenders. So we're certainly there. We're geared and ready to roll.
All right, hear there directly from the CEO, Paul Glossop, Finni Mortgages. What Google you? Is that the best way?
Yeah, Google finni.com.au. They can jump on our website. There's a click here now button that'll just essentially take them straight to an inquiry page. Someone will get in touch with you within 24 hours, or there's a 1-800 number you can give a call immediately and get in touch with our team there and then.
There you got it. All right. Thanks for the insights, mate. I'll put you on the spot. Is that it?
For the next, I'll go out on a limb, say for the next 2 to 3 months, I think I would be 50-50. I went out on a limb for this one. I went out on a limb for this month. I don't want to make these claims because I want to see there's inflation data that's coming out this month that will be really important, I think.
Okay. All right. Yep. There he is, 50-50. Decisiveness is his middle name. Paul Glossop, CEO of Finni Mortgage. Thanks for your time. Thanks for tuning in, everyone. We're writing about this stuff all day, smartpropertyinvestment.com.au. Go and check it out. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.